HOTTOGO, multifamily is hot to go. Volatility continues in the multifamily market, but fortunately, we've got a new report from Gray Capital breaking down some of the fastest and most exciting multifamily investment markets in the midwestern United States, which is one of the most exciting investment regions right now, blowing past the Sun Belt. A lot of people haven't heard of some of these markets, but we're going to break it down for you. More than that, Wall Street Journal's got a piece on the China tariffs going away. Man, we finally got here, but man, this was an insane path to take. Other reports from BLS, we had CPI print this week, a report from Yardi Matrix, RealPage, and we may even get to a piece from Marcus and Millichap if we have time. You're going to want to stick around for the whole episode. It's going to be a banger. Let's get into it. Welcome back to The Report, joined again by Dr. Matt Bosnagel, Director of Communications and Marketing here at Gray Capital. Matt, this is a great week. How you doing?
Yeah, pretty good. I think I really liked last week's episode. I think this is going to be even better. So we just keep getting better.
Me too. Well, I'm very excited to check out this new research report from Gray Capital. Mm-hmm. It's called The Midwest Resilience. It's all about multifamily markets in the Midwest. Talking about how many markets does it feature, Matt?
7.
7 different markets. Very critical because not everyone knows that much about Midwestern markets. Flyover country, what do people do there? We talked about that last week, and we wanted to take a deep dive to understand why why we like these markets and to be able to share with folks who might not be as familiar. But as we start most of these episodes, Matt, you've been deep in the weeds, digging through all the latest research, everything that's happening in multifamily right now. What's the scuttlebutt? What's going on this week in multifamily?
For me, so I've been in the Midwestern report, and I've been working on that for a few weeks. But this latest week, I've looked into the inflection point of supply, and so I think this RealPage article where it talks about where each market is in terms of like the peak supply and how much construction is going on in a lot of these markets. And what I noticed, what I didn't really know, because I've always thought that the markets with the peak supply are going to have the most gradual drawdown in supply. But what I saw, and after looking into it, I've read the RealPage and I looked at some CoStar data, was that places like Austin and Phoenix and Charlotte, they have a lot of apartments under construction, but they have dropped off. Like there's a huge drop off in terms of proportion. So the drop off looks very dramatic, like dropping off in some of these high supply markets by like a third of what was at their peak.
Yeah.
But they're still at an absolute level building more of a percent of their current inventory than Midwest. So if you look at the Midwest markets for supply, the drop off is not that dramatic. In some cases, it's more of a wobble.
So their base just deliveries is higher than average, and the Midwest is over time. So they're coming back down from their extreme peaks to what they would consider a moderate level of supply growth. But for other markets like the Midwest, that's still relatively high compared to
and
markets.
Also, it's also a good reminder that like the conditions in Austin and Phoenix, Charlotte, Raleigh, whatever, these Sunbelt markets that have had a lot of the construction, those are temporary conditions, and the market in terms of the developer market, has already reacted and really pulled back dramatically in those markets.
And it seemed like that happened relatively quick, which corresponds with your observations that really the deliveries, what are going to kind of fall very quickly also. Now, there still may be a lag in the lease-up period. That can still take, a year, 18 months. But we're not going to have, I guess to your point, like a slow trickle of a ton of new deliveries over the next couple of years. And different markets are in different stages on the path to kind of get past that peak supply wave.
Yeah. Okay. And it was interesting. I did get in a conversation with our head of property management, Katrina Green, and she was saying, like, because I was wondering at what point does a new apartment building that is across the street or whatever really start to impact the rents of your. So let's say you own an apartment or you're a property manager of an apartment, a new apartment comes in next door. And she was like, oh, no. 60 days beforehand, before that apartment is we already kind of feel it. It's in the air because the new apartment before it's finished getting built, they're trying to pre-lease and bring people on and they're really, working hard so that the minute that tape is cut or whatever it is.
People have been staring at it for the last year or so when it's been open.
So whether it's psychological or not, like there's a good case to be made that the impact on rent growth from new supply happens a lot quicker actually than I thought. But the time it takes to lease those up means maybe that pressure continues over an extended period of time.
It's also a factor of the strength or weakness of the market. And in a strong market, that new delivery is typically pushing the rents to the highest of the market. It's the brand new thing, so people are willing to pay it. In a soft market, they can't achieve those top of the market rents, and so they may even give concessions, lower rents. And then instead of the older property being able to kind of narrow the gap and raise their rents because the new delivery is so much higher than they were, that new delivery actually lowers their rents and butts up against the slightly older property. That older property has to lower their rents. And that's what we saw really throughout the Sun Belt, but other markets, where in a traditional kind of more normal market where you kind of have, again, moderate level of supply, it is that former option of where that new property can kind of lift some of the surrounding rents because they're $500 more a month than you. Well, maybe you can raise your rents $100 and still not miss out much traffic. You're still a value.
Yeah. And another factor that I was looking into as I picked for this research report some of the submarkets and really the markets in general is you don't want to get if a market is really small, then you're going to see more volatility when new supply comes online. There you could see huge spikes in the supply, whereas if it's a larger market or even really like a larger submarket, you're not going to get as huge of a splash if a new apartment building comes up.
Where can people, where can folks go to download this report, Matt?
www.graycapital.lc.com/Midwest-report.
My God, that's
Midwest-report. graycap.net/Midwest-report, or just go to graycap.net. Click on the big link that you'll find right in there.
Graycap.net, and you'll find it right there.
Yep.
Awesome. So let's jump right into some of the stories this week. We're going to get back to the report, go into it through detail, but first on the docket, just because tariffs have been driving so much fear and uncertainty, we got to try to not close the loop on them, but we got to give a quick update because it's going to impact future costs of housing and uncertainty in the economy. But this weekend, there appears to be some sort of a deal struck with China. The extremely high tariff rate was 150% or so. It's back down to 30%, which is still pretty high, but it's much lower than 150%. This has calmed a lot of markets. The stock market's been in the green the last couple of days. People are very excited. The title of this piece is from the Wall Street Journal, Trump's China deal makes sense. How he got here doesn't. I don't think that's a big surprise to anyone. Is this a what's your take, Matt?
I don't think that Trump
is it over? Is this behind us? Are we moving on to taxes? Are we moving on to getting the Ukraine-Russia war, which does this have anything to do with multifamily? Are we past it? What do you think is going to happen?
Well, I think it has to do with multifamily. For one, I think uncertainty makes people sit and wait. I think that is, and we'll see if we get to the Marcus and Miller chap, that trading, like buying and selling the multifamily properties went down a little bit in the first quarter. I think partly because of the uncertainty about what's going to happen with the economy.
Has the damage been done?
I don't know. I don't know. I think that there's a good case because of the way that the markets have reacted to maybe think that, as this tariff issue progresses, maybe it's not going to be as bad as people think. However, this is the way that I'm seeing this, the way that it's like kind of reading into what's happening right now is this is very abstract. The reality of tariffs have not hit. The store shelves aren't empty yet. I've heard about empty cargo ships, but they haven't shown up in people's kind of day-to-day lives. Even though the abstract sentiment is so low, it hasn't really affected the price of eggs.
Do you think most Americans are aware that there's been a trade deal that's been struck with China?
Because
I'm getting to the sentiment.
Why else would the sentiment be down? Because the job growth is relatively strong. Inflation is getting better. So I wonder if they are on some level familiar with it, whether it's a trickle down of business leaders getting scared and they're not hiring, but labor in general, I don't know. Maybe it is a knock-on effect. I don't know. I don't think they're informed. I don't think everyone is thinking about tariffs.
I don't think that they are, but I think that people have already made the decision, I think in some cases, to go into kind of shelter mode and defensive mode, and that we're going to have tariffs. Maybe there's going to be a recession. We're going to have to tighten the belts. Maybe we're going to have to do some layoffs if we have to. I think people are getting defensive, which is reduces spending, and there's so much noise. Yeah. That this is just another piece of the noise, and even though now we're maybe in a different world where we don't have basically a trade policy that excludes trade between our one of our largest trading partners, that normalization isn't going to actually seep into the psyche of the American public. And so, do we push ourselves in a recession? If we're not in a recession already, even though the fundamentals are good and the fundamentals have changed more to the positive, but the psychology changes spending habits from consumers and businesses and just drives us into a maybe short-term, technical recession.
The caveat that I would put in, or maybe just kind of extend my point before, is this has all been abstract. The stocks are a forward thinking are moved by forward thinking assumptions, and they're trying to predict on like what the tariffs are, and the store shelves have not been empty. Once we start really seeing and there will be stories. There'll be lots of pictures of empty shelves.
I was gonna say, all it takes is someone to empty a store shelf and take a picture. I'll just take a picture when they're stocking it. To circulate it around.
And once that happens, I think that who knows? It all really depends on the Trump administration making a predictable plan on how to move forward. And what this means, the China deal means, is that tariffs are still as higher than they've ever been with China. And same thing with that floor of 10% tariffs on everyone. That's higher than it's ever been in decades. And so I don't think we've fully seen the market react to it. We've seen anticipations and kind of abstract, and maybe there are some contracts that have to be changed, but like on a consumer level, I don't think it's really been felt yet. And the story is just still being written.
Well, and on that point that the story is still being written, if this is the beginning of a rollout of trade deal announcements, we had the UK was the first, and then we obviously had China, which is kind of was the big elephant in the room. If we continue, Trump's in the Middle East right now, a lot of controversy. They're rolling in the McDonald's on wheels, the portable McDonald's. Qatar's gifting him or the government or whoever a plane. I can see a lot of the Saudis want to make deals. There's going to be some deals announced. There's probably going to be deals announced throughout the Middle East. If we're beginning a season of announcing these trade deals, could that flip the market, to the positive? Or do you think that's going to happen, or is it all just going to be noise, and we're just going to be thinking about just the messy way that this has all come about?
Well, I think it's a very unpredictable way to rely on individual deals that may change. But I think the market has reacted positively every single time a deal comes out. It's like, the market desperately wants to be positive, at least the way that stocks are. With every sign of every visit and every little piece of news, it shows that there is this underlying positivity and underlying, I would say, like a foundation of a really good economy. If we could get somewhere where we can just predict what tariffs are going to be, where there's no chance that, all right, in 90 days or even after 90 days, I just make up a new deal, because now I'm thinking about fentanyl, and now I'm thinking about the trade deficits, and now I'm there's lots of, and that's part of what this Wall Street Journal article is about, is the inconsistencies on some of the goals. Like, he did say China and fentanyl, but then like why does that mean that what is it here? That paragraph on Mexico, and so the 20% is officially tied to China's role in the flow of fentanyl into the U.S. Trump officials say China has shown readiness to act on that problem, yet Canada and Mexico, who have already acted, are being hit with more tariffs. So there's some inconsistency, and the reason why inconsistencies isn't because of like randomness. I think that it is because this is all negotiation. Negotiations can go in different ways. And if things are subject to negotiations, which are a little bit random and unpredictable, that's hard for me to think that businesses are going to like that. Business likes predictability, stability. If they could have this rule that's like X amount of tariffs for this much, but now that it's just like one trip or one meeting away, who knows what's to predict. And what I'm really scared of is that the consumption draws down because people are waiting and seeing. They're putting their money in their wallets and they're not going out, and they don't want to take action, especially business leaders.
Well, all I can tell you is the Chinese propaganda really worked on me, because all I've wanted to do over the last couple of weeks is import random things from China.
Yeah.
They've been feeding my social media with all kinds of industrial products and goods at rock bottom prices, well below that you can get anywhere else, and I'm like, why haven't we been importing everything from China?
And now, like, what does the de minimis tax has gone away? So now that's going to hopefully be a more of a benefit. But I wonder if we can talk about the CPI.
Let's move to the fundamentals, because obviously that will continue to change. But this was downside surprise, as in less inflation than we were worried about. Again, it's probably early for some of this tariff news to seep into inflation. But we were worried about a re-accelerating economy. Are we going to be able? There's been talk of maybe we're going to have to hike the Fed funds rate this year to be able to get inflation in check. No data to support that at this meeting. If anything.
I think that we mentioned egg prices. Egg prices dipped. They went down by like 12.7%, which is the most they've ever gone away. But I will repeat what I've said it before, say again. Egg prices are the result of industry-specific factors and are not an accurate measure of inflation.
I think people have heard you loud and
clear. I want to put clap emojis between every word so that they're not a factor of inflation. It's all a bird flu, but they're fun to talk about. If everyone's going to talk about egg prices, then sure, I'll keep following.
But what about this shelter, Matt?
Shelter looks like, and I put it in my notes.
It's going down, but it's still positive.
Yeah, and that the numbers for shelter were the same as the numbers for rent of primary residence. I think we're approaching a point where we can't rely on the lagging rent growth decline to be a factor that is disinflationary. I think that we're about that time where things are pretty much reverting to the mean. I may eat my words later, but it does seem like shelter is going to be less of this outsized inflationary factor. However, it was the biggest factor in inflation this past month. So it's not going away. It's just like at normal while everything else is slightly reduced.
And that does make a little sense. Earlier in the year, again, we have seasonality. We talk about this a lot. There is more rent growth. But again, that doesn't make sense for this print of shelter, because it's lagging. It's not necessarily, we're not picking up all of the new leases that were signed. We're looking at all of the leases that have been signed, or approximation of that.
It's interesting. I just heard in some of the podcasts and news that's following rents, I just heard someone actually acknowledge that rents are going down in Austin. Oh yeah, they actually are. So it has been this narrative for the past 5 years, and really largely even before then, that rents are going up. This is this huge thing. Rents are, but like noticeably, there has been a lot of apartment building in the past 3 years, and rents have gone down as a result of it. And it's good to know that at least in like the conversation, like the discourse of housing shortage, that people are acknowledging the rents. So hopefully they're getting the picture that the more you build, the lower the rents go. But
I think we've got a lot of really good data to support that. And it's the only solution is just to build more supply of all kinds of housing all over the place where it is needed.
And I got the data. I was going to do the segue. Can I do a good segue?
Do it.
And I've got really great data this month from Yardi Matrix. And as a special treat, I did a rundown of some top line numbers for rent growth for Yardi, RealPage, Apartment List, and CoStar, just to give us kind of a comprehensive look of where rent's at. Yardi has year-over-year rent growth at 0.9%, month-over-month at 0.3%. The year-over-year rent went down from 1% to 0.9%, month-over-month the same. RealPage, year-over-year went down from 1.1% to 1%, and month-over-month went down from 0.8% in March to 0.2% in April. Apartment List, this year-over-year rent growth was the same, which was negative 0.3%, but month-over-month down in April. When it was, from March. In CoStar, same thing. Year over year was 1.1% in March, 0.96 in April. So it's down. Month over month, also down from March. Typically, and you can correct me, April is a time when rents go up in anticipation of peak leasing season. The fact that they're slightly going down, either month over month or year over year, just in general, all these sources were seeing this little dip in rent growth from March to April. I don't think it's a sign of a scary crisis.
The rate of growth.
Yeah, the rate of growth.
The rents didn't go negative. But it's a great point, and I think this ties into what we were just talking about of the uncertainty from tariffs.
Yeah, and apartment owners maybe, or like.
Oh, I know. I think it's consumer. I mean, certainly the owners too, but I think it's the inability to make decisions.
Yeah,
and
okay.
one thing that we've been paying attention to is that it's exactly what this data is showing is that March was, kind of normally strong. So it wasn't like a gangbusters month, but we would expect good traffic. Good amount of leasing activity. In March, it was a little bit slower. In April, it was a little bit slower than it was in March, which was surprising. Typically, you see gradual increases of kind of leases, demand, activity, traffic, whichever metric you want to look at. Starting in March, April's a little bit more, May's a little bit more, June's a little bit more, and often it peaks in July and then tapers off from there. Some markets it peaks in June versus July, some later in July, but typically everyone tries to move in by July, so they're ready for the school year in August. Obviously, people are different, but that's generally the way that it goes. So to see a little bit of a pullback in April, when I saw the numbers initially come out, I was a little bit surprised. But then when I thought about it, no one wants to make a major financial decision right now.
Yeah.
So we're also seeing kind of renewal rates become a little bit higher than they have historically because people don't want to make that decision to move.
Yeah.
It just one more big call. Let's just stay here. We don't know. We don't know how the world's going to
I'm pretty sure we saw a lot of this happening at the beginning of the pandemic too. Was renewal rates and this kind of stay in place kind of thing. So really interesting. And I wanted to, if you want to scroll to the list of markets for year-over-year rent growth, I kind of also want to compare it to the other sources as well. So I looked at regionally which markets were the strongest and which markets were the weakest in terms of rent growth. And RealPage has 5 out of the top 10 in the Midwest. Yardi here has 6 out of the top 10 rent growth leaders in the Midwest. Apartment List, 3 out of the top 10 growth in the Midwest. And if you're filtering markets with
looks like New York City's rent control is really working out for them.
Yeah, above 5%. That's wild. Now it is worth mentioning that New York City was like one of the had one of the lowest, like biggest negative rent growth in the nation for a while during the pandemic, but they bounced back.
But they bounced back relatively early, unlike San Francisco or Minneapolis. And they've been bouncing back for a while in New York City.
But largely, though, Midwest is the most is kind of overrepresented in all of these rent growth leaders, and we'll tie into the report that we talk about in a little bit. But also, if you're comparing it to so let's take the bottom of it's even more of like a Sunbelt domination. So for all of these. For all of the lowest markets, it's all in the South or the West. The really farthest north for either Apartment List, RealPage, CoStar is Denver. That's like the most far north, or maybe Salt Lake City. For these rent growth data sources. It's very striking. I would almost say that like the overbuilding it ties these Sunbelt markets together a lot more than like the stability of the Midwest. It's kind of mixing it a little bit with the Northeast. And there still is some, I think that for a while it was like San Jose was doing really well too and may still do well. So it's not like it's a uniform thing. It's the same thing every region, but you can't miss it. And it is worth thinking about what's the collective pressures that make the Midwest stand out right now. And I would say it's like the stable economies and less like fervent over hyperactive apartment construction. And so that's just worth noting. It's something that I follow throughout all the reports here, especially in the Yardi Matrix one.
It's amazing. We talk about this all the time, but this bottom group right here, Austin, Denver, Phoenix, Orlando, Dallas, Atlanta, Vegas, Nashville, Raleigh, Houston, Charlotte. Man, these are like some of the favorite, syndication markets.
Yeah.
And again, it just makes me think if you were syndicating and you were buying multifamily properties the last couple of years and you had to pay up with a low cap rate to be able to get into that market, to get that deal done, and you've had not just a year of negative rent growth, but 2 or 3 years of negative rent growth.
Yeah.
I mean, if you've ever underwritten a multifamily property, you can't have multiple years of negative rent growth and it looks good. And then if you look at the interest rate environment, all of those factors, again, just there are it's
It
trouble.
it should make it hard for the sellers probably, but I bet you'll still be able to find investors that are interested in Phoenix that
There's
aren't
a
as informed.
ton. There's an incredible amount of interest in all of these markets.
Yeah.
But the price to pay to make the deal work
Yeah.
is so low that the current owners are wiped out. They lose all their money. Maybe even the bank loses a little bit of money. And so there's not exactly a lot of sellers that are really excited to transact right now, because if they did, they would lose their shirt. I mean, we talked about last week, Matt. I mean, out of the almost half a $500 billion of multifamily loans that are going to be maturing over the next 2 years. 50% of those have a DSCR under 1, which means they're insolvent. They don't have enough cash flow to pay the debt service. That's not good. That's rough, and that's because people were projecting. People had very little cash flow, and then expenses went up, and insurance went up, and taxes went up, and then they had to lower their rents. Yeah, as their occupancy was declining, and they had to save. They had to get heads and beds.
I will say, and I was kind of disabused of my stereotypical view of these markets as like a really scary place. It does seem like the apartment supply is going to be less of there's going to be less of an oversupply going forward. Like the construction really dropped off in these markets. However, just like what I said last week, it'll be interesting to see how rent growth moves. And I think you made a good point, especially in places like Austin that are having, over negative 5% rent growth. Maybe the base effect of that makes it easy for them to jump back to positive, in the same way that their dramatic overbuilding made it kind of easy for them to jump back to normal.
No, I agree. I think that, there's some, I don't like to time markets, but man, if you can get some, great deals in some of those markets and you get the pop, the bounce back, which there will be a bounce back. It could be a really interesting opportunity for folks in those markets, which we're not. We kind of stick to what we know, but it's an opportunity.
We got another segue. Let me do the segue. Just like the timing, we're talking a lot about timing, and so is RealPage, saying that their rent growth is evidence in markets past peak supply volumes. So the timing of these supply volumes is, according to RealPage, and I think according to common sense, the timing of these peaks in supply are really important. However, if I could summarize also another big point in this, the magnitude of the supply is I would say more relevant than the timing of it. So you look at the ones where it has the percent of annual growth at peak in Salt Lake City, for instance. This is a market that has since peaked, but its percent of inventory was so big, it still kind of seems like it's still working through that, because its rent growth is negative 2.3. Its current inventory growth is not 6.8%. I don't know what the numbers are. They don't have them on the RealPage is, but that was at past.
Peak.
Peak. So I do think that, like, as much as these markets are growing and working through, I just think a lot about how long does it take. That's why I was talking to Katrina, when the apartment moves in next door, it impacts it 60 days beforehand. You're going to start thinking about adjusting rents, but maybe that impact is still felt as that apartment fills up and is still continuing to be a pressure. And it's just a new paradigm that you have to deal with. It's not like it's like fills up and now we can go back to what we were before. It's a never ending thing, especially if there are 3 apartments coming up.
Yeah, it's more competition in the market. Exactly. Just because it's absorbed doesn't mean that it just gets easier after that, because you're still competing for those renewals and there's still an alternative.
Yeah. And super interesting too. It's like, so Salt Lake City, I group it with a lot of like the hyper growth, not fair weather markets, but the ones that were really super popular in like 2021, where everyone was remote working to, and places that looked really nice.
Great employment growth. I mean, Salt Lake City's got a lot of solid fundamentals. Fundamentals.
Oh, for sure. But these largely do seem like markets that even before the pandemic they were really popular, like Portland and San Francisco. I remember San Francisco especially, it had low rent growth for a long time, and I think part of it is it's just not housing's not a really great proposition in that city.
It had rent growth for so long
Yeah.
that made it was one of the most expensive markets in the country.
Yeah,
And so it had so far to fall from.
Yeah.
Because then all of a sudden, like, no one wanted to live in San Francisco, or very few people did. Everyone moved out, and yeah, you had a lot of apartments. People were still building apartments, but no one wanted to live in those apartments.
But yeah, so if you go to the second, so that's that first group, and then the second, there's other groups where the supply peaked in 2024, so a little bit closer here, and you kind of still see, like, if you're going, there is a fairly strong correlation between how much of their inventory were they building at their peak. And if they're building a lot, then their rent growth is probably negative. If they were building a smaller amount during the peak, then their rent growth could be positive. Because we're still seeing, like, Las Vegas has negative rent growth, but their peak was only 2.4% of the supply. So it's not perfectly even, but it's definitely, like, noticeable. You see like Nashville adds 7.3 to supply. Well, right now it's still at negative 2.6 for rent growth.
And the other factor obviously is demand, and so we've seen a lot of strong demand, especially in the Sun Belt in the Midwest. But and again, I don't know this for sure, but one case could be that Las Vegas, even though that they had less inventory at the peak coming online, maybe just the demand has fallen off a little bit. They're again talking about recession fears. There's a lot of talk about folks not going to Vegas as much, not spending as much money.
What kind of economies in these places?
Yeah, that could have an impact. And West Palm Beach, that's an expensive market. But demand would be that other variable that we'd have to take into account.
And that's another thing that it's going to make this year and the coming years really interesting too. Is we've said it before. Is as supply recedes, all these other factors are going to become a lot more relevant. We've probably discussed before how, like, return to office may be favoring some of the tech markets as the workers come back to, and that's going to be something to probably pay attention to. We'll also in this report on the Midwest, like, we look at what kind of employers are there, and what are the specific developments that are happening, and so it's not just supply, and also I think the size of the market, as I said before, is a good key for is it going to be particularly volatile or not.
Yeah. Well, let's get into the new report. Midwestern Resilience. It's a new research report from Gray Capital. You can go to graycap.net to download it. The report focuses on 7 key Midwestern markets. It's a relatively brief read, but if you want to get yourself kind of up to speed on which markets are which, what are the different dynamics, what are the employers, and there's a good amount that's in common with all of these markets, but they're all unique, all in their own right as well. So, Matt, bring us in.
Okay, yeah.
Give us a nice preview. Don't give it all away.
I want to. But just to share a few things about the Midwest specifically that you probably know from listening to this, but were kind of guiding principles that I was thinking about when I was grouping these markets together, was the Midwest has, what is good about the Midwest? And I think there's favorable supply trends, the rent growth is strong, the occupancy is strong, and it's affordable on the renter side and on the investor side. So there are things that are attractive from, like, you get a better cap rate in like, let's say, South Bend than you do in Miami.
So higher cap rate, more cash flow. You're essentially buying less, per the dollars that you're going to receive. So theoretically, the way that many folks have viewed Midwestern markets is that they should be good yield and income producing markets that maybe don't have the chance to appreciate as much. It's kind of that tried and, I guess and
that's largely true. But then I also want to say there is economic growth in these places.
I think that's what people are missing.
Yeah, and that's what's like my third thing is, like, here's the surprise. That may blow the minds of certain investors who think that the only places are growing are in the South, or the only cities that really exist are like LA and New York. Like, there is, this is the flyover region, but I wanted to highlight, yes, the stability, and I think stability is particularly relevant right now. Midwest, strong when things going crazy, and was stable when things were going crazy on the upside and the downside during the pandemic. And right now, looks like things may be a little shaky. So there are things that are particularly strong about the Midwest. But also when I was looking at the markets individually, I wanted to highlight the industries, the supply, and the timing of things, because some of them are a lot different, especially in the smaller markets like Lafayette and West Lafayette. There is the supply spikes a little more, and you have to tease out student housing from regular like market rate housing that are non-students, and it's just a different market. But that being said, we can kind of move into, well, actually, I do want to explain here this graph that shows the occupancy and rent growth for the Midwest compared to the national average. And you can see this rent growth is more than three times the national average.
Incredible.
And it has been that way since, for over a year, and from arguably 2 years. This is just as far back as the data that I had accessible right now. But and also Midwest for all but like 1 month, and this is the most recent month, occupancy in the Midwest has outdone national averages too. So the Midwest markets are outperforming on a range of different issues. In that last month of occupancy, just a teeny little difference.
Yeah.
But it's very striking to see this. It is shared slightly with the Northeast as a region, this kind of similar strong performance, but I think there's more multifamily markets that are interesting, at least to me, in the Midwest. And the Northeast, there's like New York is, to me, such an outlier. It follows so many different rules, so it's hard for me to get a handle on Northeast. I'm just less familiar with it, and I think that the stability story in the Midwest is really particularly interesting. That being said, so like the markets, the criteria that I used to pick these markets are really, they're just supposed to represent. I wanted the markets that represent this stability, that shows that when things were going crazy, the Midwest was doing great. That maybe also shows that when rent growth was peaking in like nationally, the rent growth of the markets maybe didn't peak, but maybe after it, when the rent growth dipped down, the Midwest was doing great, and that overcame the missing of the peak.
I think some of the compounding effects of, maybe we're not peaking out when everyone else is peaking, but we're also not seeing the declines. And so we always stay in typically positive growth trajectory, but much less volatile. So you don't really have to time anything. If I don't have to time anything, you can just kind of stay in the market.
Yeah. And I think we put our best foot forward here with this first market that I featured, which is Indianapolis, Indiana. It's the home of Gray Capital. It's the home of me and Spencer. But it also illustrates the stability of the market. Didn't dip down. It actually outperformed the nation throughout the pandemic, throughout the past 5 years. But other markets that we have are not going to see the highs, but they actually overcome that because they didn't hit the lows. Midwest is a great example of like the economic growth and job growth that's happening. Its job growth is greater than the national average. Its supply is also particularly attractive. It's only building, like the amount under construction right now is 2.5%. That's well under the national average for apartments under construction. So, any which way you slice it, there's really a lot of strong indicators for Indianapolis. And also included in this report some specifics about developments that are happening, like there's Lilly Pharmaceuticals and Roche Bioscience. That was just a couple days ago. I put that in there.
I noticed that. I noticed that addition.
And so this is big bioscience presence. There's also hospital expansion, and there's also really big logistics presence in the city. It's a good thing the economy is diverse. There's not just one thing that's going to crash and ruin everything. And so that's a lot of what Indianapolis represents, is that strength, diversity. And then we have called out some key submarkets. Indianapolis, citizens of Indianapolis will be familiar with Zionsville, Carmel, Noblesville, Fishers, some of these markets in the north. And I think, I could add Greenwood there in the south. These suburban markets where rent growth is really going really well. So
no, good call.
Yep.
And it is month of May, which is a big deal in Indianapolis. We've got the Indy 500 coming towards here pretty soon.
So spotlight on that.
So staying in the Hoosier State, Lafayette, Indiana. Some folks may or may not be familiar with Lafayette. You got West Lafayette, home to Purdue University. Tell us a little bit about Lafayette. Why should we consider
it is like
it's
really interesting as like this tale of two cities, kind of, where the more manufacturing based economy of Lafayette is combined with the higher ed dominant West Lafayette, which is, like you said, the home of Purdue. There's lots of new construction in the combined Lafayette and West Lafayette markets. You can see in this chart here that deliveries are expected to grow like an enormous amount in 2026, but that is a lot. That's very concentrated in student housing. There's been a lot of student housing being built right now at Purdue, and if you're looking at market rate housing, the story's a little different. And I think that it also will be different depending on what kind of submarkets are in Lafayette. These submarkets are in like the south and east side of Lafayette and the north and west side of West Lafayette, where there's a lot of growth going in. There is an AAI. There's like a chips plant coming in, and
$4 billion.
So really big news there. There's like this agroscience, but all of this manufacturing and these business developments, like, that's great. There's going to be growth, but
and
there's
Lafayette's not a massive market either.
Yeah,
so these type of economic developments are a major impact on the market itself.
And also, like, I did want to mention, there is existing presence in manufacturing and agriculture in Lafayette that's very robust. I know Super's been in the news about moving some of its manufacturing to Mexico, but that's not actually happening in Lafayette. Lafayette, they're building Foresters there. They're going to be great, and nothing's moving.
One other factor, while we're talking about Indianapolis and Lafayette, is the 65 corridor. That whether it's you're talking from wherever you want to start, especially when we're looking at kind of our markets all the way from Louisville up the way through Indianapolis, this logistics pipeline of between Louisville and Indianapolis. Louisville is basically UPS's a major hub for logistics, and FedEx has their major hub in the United States in Indianapolis, where we've got between those two airports, most of the cargo traffic are coming in there. It's because you can access the vast majority of the U.S. population within a day's drive from either of those two locations. You can actually get fresher seafood, I guess, in Indianapolis.
Oh, nice.
Than you can in Chicago sometimes, because we have more flights coming into Indianapolis, cargo flights. And then they're being trucked up to Chicago. But that 65 corridor, over time, we're going to see, Lafayette, as it creeps down, continues to grow. Indianapolis growing up along 65. We're seeing it right now through Zionsville, Lebanon, which is where the new Eli Lilly manufacturing facility is. At some point that growth is going to continue up that logistics key logistics corridor.
It is interesting because a lot of cities have a larger footprint, and we're seeing right now, I've seen such rapid expansion of the footprint of the kind of the metro larger market area of Indianapolis, and as it expands into like Lebanon and these cities that were just little towns, and now they're arguably part of this larger metro area. So it's particularly interesting.
Now for the second largest city in Indiana, obviously we're starting with some good old Hoosier markets. Fort Wayne, Indiana, it's a sleeper market, strong, stable performance, advanced economy. Matt, what stands out about Fort Wayne to you?
This is just a smaller market that has been remarkably strong, and it's definitely worth watching. It vastly exceeded the national average in rent growth during the peak, and it continued to exceed the average. It has a varied economy. And it's just a really nice city. There are some economic developments that are happening there. It's auto manufacturing. They've got like a Fort Wayne specific campaign trying to bring businesses in, and the data centers moving in. But it's also got a base of strongs like manufacturing and other kind of businesses that are obviously like meds and beds. But what I liked about Fort Wayne was it's even like a lot of these, the supply did not get dumped on supply, and the supply that it did gain, which was sometimes it was a lot in certain years, The supply did gain, that was absorbed fairly quickly. So I just think that it is
it's off the radar. I mean, if you talk about national developers, people aren't lining up to develop in Fort Wayne. Not that it's not a growing market. It clearly is a growing market. It's just that they're not. I don't think they're familiar with it.
Yeah.
Just not on the radar.
And if we want to move on to Louisville, I think that's has a little bit of a similar story. I think it's definitely more prominent than Fort Wayne, but I think that people maybe miss how the apartment market has performed in Louisville and how the supply just hasn't been getting the same attention as others. There was a relatively recent spike in deliveries in Louisville, but it was not like elsewhere. And again, like it's not really having a huge impact on rent growth because it's still above the national average. And Louisville's, but I'm glad you called that out because Louisville is another like a logistics hub, and that's shared with Indianapolis. Even Kansas City is notable for this. This is this heartland, this connection between a lot of different areas. But it's not just logistics. You got a Meta data center coming in, this solar battery plant. There is like some snack foods. There's some food industry like Yum Brands, I think, or Yum Brands. There's like food headquarters there for food services, and it's got some interesting submarkets as well. And I'll call out Jeffersonville and in the areas in Indiana that are directly across the Ohio River from Louisville. They're growing really, really rapidly.
Yeah.
That's where this solar battery plant is going to be built, is in Indiana. So, and it would be interesting to see what the government or tax differences is if you're crossing lower taxes in Indiana. So there is ways to benefit from the size of Louisville, but also be in these submarkets that are on the Indiana side that may be having a little bit more growth.
Yeah, no, all good points. Good old Columbus. I mean, Columbus is a pretty big market.
Yeah. Columbus is very similar to Indianapolis. I think it is a little bit bigger. I think that it's had a lot more growth, I think, as well. And its supply has been more elevated compared to Indianapolis.
Outside of Chicago, would you say Columbus is the most institutional market?
I would say,
at least on the list.
I would say that, and I would say too, because there's a lot of reasons why people are paying attention. The economic developments that are forthcoming in Columbus.
Right. I see these are all Bs. They all end up Bs, no Ms.
There's no Ms, lots of Bs, lots of really exciting things happening. This $28 billion Intel chips factory, some Amazon Web Services data centers that are in total around $8 billion. A Honda EV plant for $1 billion, $1.5 billion defense manufacturing. These are all in the Columbus area, and that has knock-on effects. Elsewhere in the economy, you've got to have the restaurant manager, and they've got to all find somewhere to live.
How's it been doing from like a multifamily perspective, though?
Well, from a multifamily perspective, it has had more units under construction relative to its inventory. Among the ones that we have here, I think that Columbus may be number 2 in terms of the current percentage of units under construction, which is 4.4%. Compare that to Indianapolis was around 2 or something. Yeah. But like Lafayette was around 6.4 just because of the student housing. But this one, I think they still are. Apartment developers are seeing that chips factory and seeing all the businesses coming in. They're building apartments, but it hasn't meant that rent growth has gone down that much in Columbus, and rent growth is still above average. It didn't peak higher, but it has been well above the national average in Columbus rent growth comparatively. Now I'm going to have to do these next 2 on the fly because I really wanted to focus on this first 5, but Cincinnati is well worth noting because, again, it has this logistics, this connection to logistics. It's not on 65, but it is on the river. Cincinnati has been... just looking at the supply and demand and how it relates to rent growth, it's seen some supply spikes, but the rent growth has not dipped down, and it just seems like a really consistent, strong, growing city. It doesn't have any B's in front of these economic developments, but it'll see a $327 million med space clinical research facility going in there. There's an addition to Xavier University that's $100 million. That may not be, directly economic, but like this is money being pumped into there, and as well as a $240 million convention center. Things are growing in Cincinnati, and it wasn't hard for me to find this kind of stuff, these developments. Some of the cities that I was looking into that may or may not have been that weren't included. You got to do some digging to find like the good like economic tidbits. But it really wasn't hard to find for Cincinnati, and
they've got a good PR team.
Yeah, they've got a good PR team, and there's a bunch of people moving in there.
That's great.
And then Lansing is it's a relatively smaller city. It is the seat of government in Michigan. It is also still growing. It's just like not this flashy, like exciting Columbus. It's just doing its own thing, and people are living there. And it also has. It's not like farmers or anything. You've got these battery plants coming in. There's some biotech expansion. There is some. It is interesting because I think Lansing falls by the wayside. People pay a lot of attention to Grand Rapids.
Yeah.
But there's this whole corridor in Michigan where it's like this stripe of Lansing on one side and Grand Rapids on the other, where there's just a lot of development and growth. And I think that was it includes Michigan State University is in Lansing, but it is, again, it's one of these sleeper markets where the supply is a big deal. They're not building any of it all. Like, if looking at the chart of supply for Lansing, it is as sparse as any market that we're looking at. And if you're looking in the next year, it doesn't look like they're building much in Lansing. So.
And the population is growing. So again, because the counter argument, it wouldn't necessarily be correct, is that the reason why these markets are cheap, you can get a higher cap rate, or the reason why people aren't building more apartments is because there's no demand, no one's living there, people are moving. These are Rust Belt towns, which Lansing would probably be more Rust Belty than some of the others. None of these are like Cleveland and Detroit are like the prime examples, and like an Akron, which those are not necessarily these exciting markets for that didn't make this report. They didn't make the cut. I mean, Chicago is also interesting. For a lot of reasons, very different, dynamic market, very strong rent growth right now, but a very large market. But it's got relatively not great population growth in certain areas, and it's because of that no one's building, and therefore rents are growing. So it can sometimes be counterintuitive of where it's like there's a sleeper market, there's nothing really going on. That often can be an opportunity because that means there's less competition. Yeah,
and particularly in Lansing, paying attention to the submarkets is really important. There's a lot of variance. That's at the bottom of the screen a little. There's a lot of variance in all of these markets with their submarkets, but picking the ones that have an ample like inventory, so enough people are living there. It's not like 500 units are in their supply, but there are like thousands of units, and they're also still growing. The downtown actually in Lansing is growing pretty well, but also this East Lansing and the Okemos region has been mentioned several times in different publications as one of the strongest areas. It is around where Michigan State University is, and there's lots of businesses that are moving in there that are kind of connected, and it gives it a little bit of longevity too. So like Lansing, small, not going anywhere. Fort Wayne, smallish, not going anywhere. Neither is Lafayette and West Lafayette. And that's why I wanted to hit on the diversity of these economies. It's not a one-horse town. It's not a one-industry town that if they move, then everything's gone. There are multiple factors that are driving this longevity, and even if population was flat, population goes flat, the supply stories on this, they're going to need more supply, and that's not happening in a lot of these Midwestern markets.
Yeah. Mostly these are pretty affordable, diversified economies and relatively off the radar, at least from multifamily investors in the last cycle. I think there's going to be getting some more attention now, but nothing compared to what the Sun Belt got. And, part of us wants to keep it that way, but these are really good markets for everyone to pay attention to and keep on the radar as opportunities present themselves.
Yeah.
One more, though. Kansas City, Missouri could not leave KC off.
I think this is an interesting market. Yeah. It is one that I commonly thought of as alongside Columbus. I think of it in kind of like Indianapolis.
Columbus, Indy, and KC all remind me of each other.
Their size is relatively similar. Their economies relatively similar.
Latitude.
It is the same latitude. They're all kind of logistics connection cities for the surrounding area. Kansas City maybe performed a little bit worse compared to Columbus and Indianapolis rent growth, but it's still remarkably stable, and it has still done ever since early 2022 has outperformed national average in rent growth. There is lots of businesses moving in there. This Panasonic EV battery plant, $4 billion. A roofing factory, $300 million. A fintech hub, $175 million. A data center, $800 million. Now, I do want to say these data centers, they may bring...
they don't employ that.
They don't employ...
They employ some people. It does take people to build them, though. I mean, it's a short-term boom to like construction jobs while they're being constructed, but...
Yeah, similar, but like I said, diverse, really great, strong population growth, income growth, and the supply growth isn't going crazy. So this is one of those where you can predict the future. It's not going to be that volatile.
Look at that population growth, 14.5% between 20 and 44. Ages 20 to 44 was between 2010 and 2023. That's a pretty strong growth rate.
Yeah. And again, solid rent growth as well. Well above the Sunbelt markets. It doesn't have the supply to work through, and the projected supply is not really going to be scary in terms of oversupply or anything like that.
Well, make sure you hop on over to graycap.net, download this report, get in touch with us if you have any questions about it. Matt, you want to finish up with the quick talking about this Marcus and Millichap piece?
Yeah, just a couple notes
because we teased it maybe 3 times, at least 2 times. And so it's like Rumpelstiltskin to mention Marcus Millichap. Don't say Marcus Millichap 3 times.
That's right. I just wanted to discuss it and as a little bit separate from the roundup of reports that we did with, and I gave you all the rent growth numbers from Apartment List and RealPage and so on. They have some interesting data here on absorption outpacing supply. They're tracking this recovery in the apartment market. I will note that Marcus and Millichap, among all these different places, they're probably the most optimistic. I may have said this last week. They had a series of videos like why retail's poised to do great, why industrial's poised to do great, and then I think multifamily may be poised the most. But that's just my own opinion. It does look, concessions are really interesting. And I was, if you scroll down a little bit, it talks, that blue chart there at the bottom of the page shows how concessions actually, so the first peak was in, let's say, mid-2020, like that initial lockdown period. And then concessions went, they bottomed out in early 2022 when rent growth was super high. We had another concessions peak in late 2024, maybe mid to late 2024. That's weird to me. I don't know, because I get it, the early lockdown period, that makes sense, but we weren't having as dire of straits as we were in middle of last year as we were in that initial lockdown period.
Well, I mean, we've talked about this. I mean, what was going on last year?
Well, that's the continued stagnation and oversupply.
No. It's the oversupply. It's the new deliveries.
Yeah,
everyone's got to give a concession. You got to get somebody to move in, and then it becomes concession wars.
Yeah.
They put a guy across the streets offering concession. Well, you got to offer concession because renters are talking. They're saying, this guy's giving me $1,000 Amazon gift card.
Yeah.
Like the rent's like $50 between the two. I kind of want the gift card. So I'm going to go buy something to move in.
Okay.
And so everyone's giving away these concessions, whether it's a gift card, which can be kind of booked differently in the financials, or it's an actual concession to, like $25 off the rent or a free month rent that's amortized. Different ways to do it. But no, it doesn't surprise me. I mean, again, just so much competition.
Yeah.
So much competition. You have to do something to just differentiate.
And it does, to me, and makes me think that the concessions may trend down slower. There was a big drop off in concessions at the previous peak, but I bet that the concessions aren't going to drop off as precipitously as they did in like 2020.
I think you'll see a drop off as the data comes in for early this year.
Yeah.
You know, as supply is kind of coming off. Like we had more concessions than we would have liked probably last year. That lines up. That's why I wasn't surprised when I saw this, I guess.
Yeah.
But we're removing concessions.
Okay.
You know, we have been for the last month or so.
Okay.
Because there's a lot of demand in the market. We're seeing good traffic. But we're taking it one day at a time.
Yeah.
Again, April was relatively slow compared to March. It wasn't bad. It was good, but it just wasn't as good as maybe it could have been. And we're trying to not give away too much, but also still have an idea about what our defense is.
Okay. Yeah. So a little bit more exciting, a little bit bolder is these predictions that they have for the market. We can look at supply trends a little bit first, but I like these basic, you get, what do they think effective rent is going to be at the end? They're saying at the end of the year, we're going to get a 3% increase in rent. I'm not.
What do you think about that, Matt?
I'm not sure. I think that it would be closer to 2 or 2.5. I looked at our forecast that we put out at the end of 2024, and we said 2.5%.
I think that's an I don't know number.
Yeah. I don't think that it is. Maybe they don't have like a whole sophisticated mathematical.
And it's not because they don't want to know. It's not because John Chang and the team over there are incredibly sophisticated and produce great stuff. I just don't think there's really any way to know. And so it's long-term historical, maybe up, maybe down. 3% sounds about right to them.
Yeah.
That's the long-term historical like standard assumption and sort of average. And I just, too big of a coincidence. I think.
If anything, they seem to be forecasting a slightly better, hotter market. Yeah. So 10 basis point decrease in vacancy, a stronger rent growth than last year, and construction at only 410,000 units completed compared to last year was like 500 to 600 units completed. So.
Yeah. Well, and again, it's hard to sell apartments if you forecast negative rent growth.
Yeah. They talk about specifically when they're talking about supply, they say major markets with a combination of tight lower tier vacancy and some of the nation's highest overall rents stand to garner attention. Many of these metros are in Southern California in the Northeast. However, Miami and Chicago also fit this bill. I missed the word Midwest in there. I don't know if you can see it. Oh no, they flew right over the idea of the Midwest. But that's fine. We do have a report that you can read.
I'll call Peter,
and we'll send him our report and maybe just imply and like I'm not just pulling this out. We looked at all the sources for the rent growth leader, and all of them were in the Midwest. It wasn't sometimes in Southern California. It was all times in the Midwest.
That's where they've got the inventory to move.
Yeah, that's right, and that is true. Like Marcus and Millichap, they have a business, and this is a product of their business, and you kind of have to filter it through that. I don't think that this is inaccurate at all.
No, I like the reporting. But Peter is going to put you in touch with the broker. It's definitely like a information, good information, good report. Sales document like some of our stuff is.
Yeah.
But they're hoping that you go and buy some apartments this year because that's what they need to do. I'm curious, price $1,500. Do we have to pay $1,500 for this? Man?
No, this was publicly made available, and you can have and actually viewers of the Gray Report will be able to click on the link, and you'll go right there that you can download that, and it is made publicly available. If this was priced at $1,500, then I'd have to pay that. And all I had to do was sign in to which is free. Sign in and get this PDF. So I am curious. Maybe it's like the value of it. Like this is $1,500.
Is that what that means?
That's what I'm guessing it means. This says,
wow.
Yeah. Actually, if we want to talk a little bit about supply too, this also illustrates the drop off in supply. This is the page 2 of the report. Supply pressures easing. This is what kind of gave me this idea. I was like, oh, I got to look into how much this drop off is. If anything, they are underselling the drop off in supply in some of these markets. Austin, they have a blue bar for 2024. That's a lot. And then the orange bar for 2025, it's about half, a little more than half in 2025. I looked at CoStar. That orange bar should be a third the size. But even so, like, these are all the Sunbelt, like, hot markets. You see this drop off every single one of them, and it's a dramatic drop off. And I really thought that it would gradually go down, but it is like a light switch is turned off.
Well, I think that's good news for owners in the Sun Belt and the South. Whether it happens quick enough to save some of those deals that have pending loan maturities that have had negative rent growth. Probably not. It'll probably be be too late for some of those. But if you have long-term prospects, if you bought to hold for the long term, or if you're buying now, looking into the next cycle, and that's where consensus is building for very favorable conditions for multifamily for the next 5 to 10 years. And I'm hearing more from non-multifamily investors getting interested in multifamily because of these supply dynamics that are emerging. And it's almost reminding of a post-great financial crisis of where developers just pulled out and we just didn't build housing for a couple of years. And unfortunately, that really exacerbated the housing crisis. We have been treading water with 4 million housing unit gap for years now. We're building, but we keep adding to the population. So, we're basically stuck at 4 million. We've got to break out of that. And we certainly don't break out. We didn't even break out of it by the recent activity that we've just seen the last couple of years. So if we basically stop building or significantly reduce, it's only going to be exacerbating the problem. And rent, I don't think, goes down.
I think this is what this is under construction. And I didn't get to show it, so I wanted to put it up. I think it's particularly relevant to what we're discussing. You see the peak is at at some point we're building almost 1.2 million, and now we're building. This is how many for every quarter. How many apartments are currently under construction, and it is almost half of what it was. And this number, this 600,
still going down.
That number is equivalent to if you kind of track that, like the latest, and I can't do it, but if you track that back, it is that 625,000 currently under construction. That's about the same as it was pre-pandemic. You got to go all the way back to 2018 or something like that. So this is abnormally low, and the fact that we're already seeing this when, man, it seems like that's all we were living and breathing in this oversupply for so long. It's striking to me that just as high as it went up, it is going back down, and it's not because we built so much and now we're done. It is because of the interest rates that are making it so expensive. So the fact that this is decoupled from like a demand and price kind of thing, and it's more like a bank kind of thing, means we probably will see rent growth and greater demand squeezed into fewer apartments in the future.
Well, stick around. Make sure you've subscribed to Great Capital YouTube channel to follow the saga of the multifamily industry, as we're covering every single week. We have been since really COVID got going in 2020. You can go back through and watch every single week for the past 4.5 years. Matt's never missed an episode, I believe.
I know. Sometimes I'll just bring up October of 2021. Let's see.
Yeah, I do too. I do too occasionally just to see like what we were talking about. It's fascinating. So if you ever want to know for the historical record to go back and say what was the multifamily industry talking about back in 2021 during those crazy. I remember just talking about I remember the phrase, the ground is moving beneath our feet at just an incredible pace. And it was hard to fathom the reporting, 3% monthly rent growth in some months. And it was incredible, and it was all real time. And so it's interesting sometimes to go back. And so if you're interested in this period of the market, it can be interesting. But make sure you subscribe, leave a comment below. We'd love to get back to you and reach out if you have any questions. And again, hop on over to greatcap.net. We've got this new Midwest Multifamily Resilience Report available for download. It's free It's insightful. And then once you've downloaded, since you've given us our email address, obviously, you're going to be signed up to receive the Gray Report newsletter that comes out twice a week. Thursday is the big dump. It's all these research reports and so much more that it's been called the best multifamily newsletter of all time. So you want to at least check it out to see if that's if you agree with that statement or not. And, just thanks for being here. We appreciate it. All right, catch you in the next episode.